CNBC-TV18.
Welcome back. Well, no luck for the bulls really today. It's not that kind of a day. The bank Nifty is still struggling pretty much at the lowest levels of the day. 2 days in a row, we've got a 1,000-point decline. Today's decline is almost 1,500 points on the bank Nifty. It's a severe downward draft. Of course, short sellers making merry and around all the talk of what happens to banks, I mean, how much exposure to the Adani group and what the numbers are looking like. Abhishek's been looking at a lot of the research out there at brokerage desks as well, seeing what numbers are floating around. Abhishek, that's really important. So fill us in on what you have picked up with respect to the exposure that lenders have to these group companies.
Surbhi, to begin with, CLSA has written a note. They say that where does the debt sit for Adani Enterprise amongst banks is what they have written. So most banks have indicated that they have largely financed the secured or, those businesses with strong cash flows like airports as well as ports. The ballpark figure as per them in terms of exposure for FY24 is that private banks have it at 0.3% of the loans or about 1.5% of the net worth, while for PSU banks it's about 0.7% of the loans or about 6% of the net worth. Jefferies has also written a note speaking on the Adani Group debt exposure by banks. They say that the consolidated debt of Adani Group is about 1.6 lakh crore. This is ex of shareholder sub-debt fund. They say that the debt to EBITDA ratio has actually declined from about 4.3% in FY16 to right now about 3.2% in FY22. So acquisition of cement business will add about 60,000 crore of debt, but it's a strong or it may lift cash flow because it's a strong cash generating business. Diversification of borrowing mix has cut the share of Indian banks to about 33% of the debt or about 0.5% of the sector loans. So they are watching the progress, but they see low risk for the banks given the fact that, debt to the group forms about 0.5 to 0.7% of the total loans for PSU banks, while it forms about 0.3% of the entire loans that private banks have. Back to you.
Okay, thank you very much for that analysis. Karthik Srinivasan, Group Head of Financial Sector Ratings at ICRA, now joins it. Karthik, if you just hear the numbers that my colleague Abhishek had put out, it doesn't align with the kind of fall that we're seeing in the banking stocks today. The index itself is down close to about 1,500 points. What have you made of the mayhem?
Yes, good afternoon, everyone. As a rating analyst, it becomes difficult for us to comment on volatility in the stock market side. But given that financials have a fair representation on the index, both are really interlinked. From our point, what we are seeing is the financial health of banks have definitely improved over the last couple of years, and they are in a much better position today as, let's say, 2 or 3 years back.
Sure. Karthik, I know, you can't be speaking about individual accounts or individual corporates, but I think within the constraints that you have, if you could give us some sense, the concern right now is that, if there is any issue, any outstanding litigation also that starts, whether lenders to the Adani Group will be impacted in any which way whatsoever. Do you think that there is at all a concentration risk, or is the debt very widely held across PSU and private that it shouldn't really become a bit of a hiccup for the financial sector?
And at this point in time, we really don't have the entire breakup of where the debts are held. As you just articulated, a couple of equity houses have made some analysis of the same. But coming back at a sectoral level, the last couple of years, the overall asset quality pain for the system is down significantly. The capital profile has also improved. Most of the banks are significantly above the regulatory minimum requirements on CET. Forget the overall capital adequacy, even on CET levels, they are very well placed. And more importantly, we've also seen a sharp rebound in terms of operating and profitability of banks. So to that extent, banks should be in a position to withstand any shocks out here. And again, a lot of debt would definitely be secured by operating cash flows or other assets. So net, at least at this point in time, we don't see any material shock to the banking sector, at least as of now.
All right, that's good to hear, Karthik. Thank you very much for joining us. Quick comments there on banks and their ability to withstand any potential shocks. We'll come back on banks more. Stocks, by the way, banks at least are, I'm looking at ICICI Bank, for example, pretty much, kissing the lows of the day, sorry, beg your pardon. The low is, 816 or so, and we're there at about 816 point something. And I think similar is the case with a bunch of other large banks as well. 360 points on the Nifty. There's a 30-40 point move which has appeared from the lows on the Nifty, but not beyond. How should you position yourself now in the remaining, 45 minutes or so of trade? Mitessh is with us. Mitessh, coming to you late today, but your reading of the screen, it's of course one way, but how are you, what would you recommend?
Yeah. So, good afternoon, Prashant. I think a couple of observations. One, earlier we were getting support around 17,800 mark, and then from there we had bounced back to about 18,250. The next time we got there, we bounced back to about 18,150. So broadly, it was a contracting consolidation which broke on the downside as we started trading below 17,800. And the first bounce back was about 450 points. So that gives you a rough target of around 17,350, and then there's 200 average at the 17,300 mark or thereabouts. So 17,350, 300 remains the broad zone which I think the market is heading towards. Though I think there could be mild recovery in the last 45-50 minutes with the intraday shorts being covered. But overall, I think this looks like a market which will head towards at least 17,300, 350 zones and maybe even lower. Because the fact is that with this fall, I think the indicators have started turning negative. So trading with more of short biases in the immediate term, and very, very clearly looking at a lot of stocks which are breaking down and trying to explore shorts over there, barring a couple of auto names like your Tata Motors or Ashok Leyland, which are still showing good positive strength on the charts.
Okay. Any trades per se, apart from the auto names you mentioned?
So no, I have in fact two short trades right now. Nestle India is something which we had been selling earlier as well. Has given a fresh 5-day swing kind of a breakdown. So sell with a stop at 19,250 on Nestle India, and look at targets of around 18,700 to about 18,650 here. The other one is Apollo Tires. That's a stock which is broken key important short-term moving averages, so could see more profit booking led selling over here. I would look at targets of around 295 to about 294 and a stop loss at 315.
Okay, all right. Mitessh, thank you very much. Good speaking with you. Appreciate you joining in with that. Dipan Mehta, Director at Elixir Equities, is joining in. Dipan, coming to you a little later than usual. Thanks very much for joining us. It's a Friday, but not a good one because significant pressure. What do you make of it? How would you characterize the sell-off? Do you think it gets worse, or are you already using this to buy what you like? Because there is a bit of collateral damage as well, unrelated damage as well.
Good afternoon, Prashant, and thank you for having me on your show. I think the biggest problem here is the sentiment, and clearly trader sentiment has been hit by the research report which has come out on the Adani Group. And apart from that, also, I think analyst after analyst, especially the FPIs and FI investors, they have been highlighting the expensive valuations of Indian stocks. And now that is coming into play over here as well. And that's why we are seeing this kind of a risk-off trade as far as India is concerned. But I think what we are seeing here is a shakeout taking place of all the weak players and the leveraged players over here. Stock gradually moving into stronger hands per se. And also there is a compression of the price earning multiples taking place over here because by and large, even on good results, stock prices have corrected, which means the P multiples clearly have gone down, and that provides a bit of a comfort and margin of safety from a long-term investment perspective. And to answer your latter part of the question, I think this is a great opportunity. This correction is a great opportunity to get into good quality growth businesses, outstanding businesses, where valuations have gone a bit haywire. But now I think they may have come back into a reasonable zone. And if further correction takes place from here, then there'll be decent margin of safety as well. So I think investors, especially long-term ones, who are focused on buying good quality, outstanding businesses where there's earning visibility and good corporate governance standards, for them, this is a very good opportunity and they should look at increasing their exposure to equities.
Okay, all right. Hi, Dipan. Dipan, we're talking a lot about all the stocks that are down. Let's talk about a couple of stocks that are doing well. What about PVR? Did you watch Pathan?
No, but looking forward to it perhaps this week.
Yeah, I mean, it's an interesting movie. I did catch it yesterday, and it's quite an action-packed one. I give it a thumbs up. But Dipan, the important point out here is 55 crores opening. Yesterday, they built on that, and they've still got the entire weekend. to build on to that. Now, that's very, very good news. I think the ratio is approximately 48-52% between the, the producer as well as PVR. What's your sense? From here on, at around 1,700 rupees odd, everyone had thrown in the towel. Bollywood's not giving us good content. Out of nowhere, Shah Rukh Khan comes in there and bats well. Your view on PVR? The last couple of days, in fact, the stock is up 6%, while the markets are much lower.
See, I think it's a good trading opportunity because all of these numbers get reflected in the March quarter, and even the December quarter was pretty decent because of Avatar. But that's going to be the problem area with multiplexes, that you're going to have lumpy earnings, and that doesn't really, kind of enthuse long-term investors per se. And then there's always this fear that entertainment habits are changing, and trying to predict box office collections is more difficult than trying to predict stock price movements. So I would be a bit cautious at these levels, and I think that you can have a trading rally, but I don't see very good earning visibility 2-3 years down the line. And business per se is quite capital intensive as well, so return ratios are on the lower side. But on the positive side, you have a merger between Inox and PVR, so it's a bit of a confusing picture. And at least I don't get the conviction that it's going to be a great long-term play. So I'm not looking at investing in multiplex at this point of time. There are so many opportunities in other consumption-oriented businesses, in similar kind of businesses like QSR, retail. I think there's better visibility and there's better longevity of earnings over there than perhaps in the multiplexes.
There's one point, Nuvama Research, erstwhile Edelweiss, they've also added another thing which is pro-PVR. They're saying that we see international OTTs cutting their budgets by 30% this year. So this bodes well for players like PVR, right? So yeah. OTT was the big competition, and we kept talking about how people are moving to OTT consumption. But if OTTs are under stress and it's a challenging environment and they cut their budget, then again, you can go back to the movies, right?
Guys, I'm so happy that you all have started talking about like the happier things. It is Friday for what it's worth, right? So Nigel, thank you for that turn. It was much needed. In fact, I was going to ask Dipan about a related sort of stock that's actually doing well. Dipan, good talking to you after a bit of a gap, first of all. So great to have you on the show as usual. Will you, you might not go to, you might not buy PVR, but would you drive to the theatre to watch the movie in a Tata Motors EV maybe? I mean, look at the stock. The earnings have been blowout. This is one stock that hasn't rallied like banks, for instance. Would you be a buyer?
Good morning, Subhi, and thanks for having me on your show. The Tata Motors is a very complicated company. And just when you expect that the company is not going anywhere and the results may not be that impressive, they suddenly pull a rabbit out of the hat. And that's been the case with Tata Motors. There are far too many moving parts over here. And sometimes you do get a surprise earnings like this. But by and large, I'm not that positive on Tata Motors, because when I compare with what I can buy like M&M or Maruti, I think there's greater visibility over there. With Tata Motors, you're essentially getting into GLR, and then when you get into GLR, you look at the US market, the European market, the Chinese markets, and one geography is doing well, but the other two are doing badly. So it's a bit of a jumble over here, and I don't get the comfort that the earnings sustainability will be there on 3-5 year basis. Whereas I get more comfort when it comes to M&M, Maruti, which are purely domestic focused companies, exciting models, new model launches, long waiting lists for them. And operating leverage is coming into play. Commodity prices are pretty much contained. So on the overall picture, when you look at these three companies, I feel that Maruti and M&M score slightly higher than Tata Motors. So I know the stock has rallied today, but I wouldn't look at participating in it.
Okay, all right, Dipan, you have a good weekend, and thanks so much for stopping by. I'm glad we're ending on a positive note. So we look forward to chatting up with you next week itself. By the way, those pullbacks that we've seen the last 1 hour odd, they've got sold into. Final 30 minutes coming up. Let's see whether or not we get a bit of a bounce from the low point of the day. For the time being, slip into a short break. On the other side, our alpha manager of the day, Trinity Bhattacharya, Fieldwise AMC, will be joining in.